And good morning. It's April 1st, 2010. A couple hours before the open, about 6:38 a.m. New York time. I'm Dennis Hudson at OrangeQuant.com. I had promised you a new evaluation of the SPY ETF, or the S&P 500. And this is the end of the quarter, and it was time for me to do that. And that's what we're going to cover. And all I'm going to use for this exercise is the synthetic trend lines, and that you can learn about in the FLIR 2 ebook, so that you could apply this to any other stock or currency or whatever you want to do. But it won't be hard to follow. You'll be able to see what I've done. You just won't know how to construct the trend lines here. And I think it's useful information. Now you'll remember this first quarterly chart from a previous broadcast. And I've left the old lines there so you can see them. And I'm going to overlay some very fat new synthetic trend lines, because what happens is sometimes, synthetic trend lines do expire, and they roll over, you might say. They retain some of their previous properties, and they acquire some new properties. And that's what I'm going to show you here. This was the old picture, and as you can see, we had for the last quarter, ended yesterday, we had a 118.17 high of the quarter. So it went right up to the forecasted synthetics, and by the way, that forecast could have been made as long as over a year ago, and that could have been made, which would have been, in other words, could have been made way back here where I just circled that red candle there. That's how powerful this is, and if you had known that, I mean, that would have been really valuable information, wouldn't it? Okay. And no, it could not have been made up here at this top. It could only have been made down at this lower point right there. I don't want to oversell this, but 5 quarters ago or 4 quarters ago, that's a pretty good forward-looking information system. All right, so we have the synthetics there. Let me produce for you the other synthetics, and if you just hang on one second, there, those are the other synthetics. If you overlay them right there, that would be, well, you could do it there, but actually you wouldn't do it there. You would use, the assumption is, by the way, before I get any further afield here, the assumption is that this past quarter marks an inflection. If that's not true, and I'm not saying it's forecasted as an inflection, I'm saying if it marks an inflection, a high, and the next quarter has a lower high and lower low, that is the quarter we just entered, then this is the way things are going to stack up according to synthetic trend lines. And you can see how what kind of path price could follow. It could follow that fat light blue line, or it could follow the fat light green line. My opinion of this, from experience in working with synthetics, I'm going to rotate this image a little bit. My opinion is that if this past quarter just ended was an inflection, then the governing trend line is more likely to be the bright green one than it is the bright blue one. Okay? And here is why I'm saying this. Let me see, how could I best illustrate this? Okay, let's take this, and you see how price more closely follows or oscillates around that bright green trend line. than it does if I flip this over. Well, if I slide it over, that red set of red bars is hardly following the blue trend line. It's closer to following the green one. And if I move this around, let me flip it and show you something else about this bright green one. You see the last, the up leg there with the green candles going up, how closely they follow the green trend line, and they do not follow the blue trend line. These are little things you learn when you're working with synthetics. And of course, this over here, the far left trend, has really nothing to do. It splits the difference between the two. It's because it's just really not related to these trend lines. That construction is not related to prices over there. So I'm saying, and I'm going to flip this again, I am saying that we're looking at right now price following, sorry, got it in the wrong place. Price more likely following that fat green trend line, okay? In fact, even if this is not the inflection, let's say the coming quarter goes up a little higher to where the point of that blue-green angle is. Let's say this quarter gets up in there, which it possibly could, to about 120, 125, then actually these trend lines wouldn't change that much, but there'd be a slight adjustment, very slight. Okay. And once again, as mentioned in a previous broadcast, notice how strong that pink trend line is, the pink. And notice how it precisely splits the blue-green pair, even though it really is not part of the calculus for the blue-green pair. When I say calculus, it's just my way of saying, you know, how it's constructed. You don't have to know calculus to do this. Gee, 6-year-old could do what I'm doing. All right. This is the expected pattern, something like this going down there. Now let's look at the weekly, and I'm going to take this off of there. Let's look at the weekly, and go back for a minute, because whoop, not there. Back to the quarterly, and let's see that again, because I want to note the price. Okay, let's say that would mean a high for the quarter of somewhere around 110, okay, and possibly as high as 120, assuming it did get up, you know, and that it's the inflection, okay, 110 to 120. So just kind of remember that for a minute while we look at the weekly. And you can see that on the weekly chart, you know, if we were to, and the stronger, again, I'm not going to flip these around for you. The stronger line is actually that pink line, and it's more likely to follow that. And if we consider a quarter, you know, being what it is, the 12 weeks, we are looking at, and sorry, I mean 13 weeks, we're looking at a potential decline on the weekly of it getting all the way down to where you see this big dot right about here, all the way down to about 95 or 97, which is not likely. The weekly chart's likely to fluctuate more. But remember, on the quarterly we said about 110 to 120. Okay, well, right about here is where that weekly chart could bounce and go back up towards 117, 120, wherever. And the inflections are noted here. One is about 1.5 weeks out, and one is about 2.5 weeks out, assuming that this week doesn't exceed last week's high. So we're now able to revise our SPY forecast downward for the coming quarter to anywhere between 110 and 120. I'm Dennis Hudson at OrangeQuant.com. Good luck out there. Stay with me.